Hey, good afternoon, everybody. Uneducated economist. Thought I'd come out here to the beach today. It's a beautiful Sunday in November here. I'd like to give a great big shout out to everybody who's been subscribing to my channel. You guys have just been awesome. I really appreciate the support. I never would have expected this channel to blow up as big as it has. I've gotten like 700 subscribers in like the last week or so. Just truly amazing. I mean, from the bottom of my heart, I really appreciate it, guys. Thank you so much. So I thought I'd come out here and give you some more of the good stuff. So I got this one out of the, let me see here. It was out of the National Interest, right? This is this publication, the National Interest, and it was written by a guy, Samuel Rhines. Sorry, it's a little breezy out here, so I'm trying to keep my papers straight. But Samuel Rhines goes on this to say, he says, the Fed may be let me try it again, guys. The Fed may try to be on autopilot, but it's never quite that simple. It has a significant amount of uncertainty to confront. From trade deals to tariffs, there are numerous ways that things could go very right or very wrong. Uncertainty, especially with the reduced amount of traditional firepower the Fed currently has at its disposal, should give Washington pause in setting policy on autopilot. One of the things I noticed right off the bat is that he uses Washington and Fed as if they're the same thing, and they're not. Our elected officials are not part of the Fed, right? The Fed is a privately banking institution. It makes its own decisions. It has its own rulers and leaders there. But I think probably what's more important with this sentence is the uncertainty, especially with the reduced amount of firepower, or with the reduced amount of traditional firepower the Fed currently has. So what they mean by the traditional firepower, back in 07, 08, when we had the recession, the Federal Reserve was able to drop interest rates because they had interest rates right around 5% for the federal fund rate. They dropped that down to essentially zero. It was like within a half a point of zero. And this gave the ability for people to take out loans for houses and cars and credit cards, and it was cheap credit, right? So they were able to take out all this credit and then go out into the system and start buying things. And that's where the Fed had ammo, right? They were able to drop these interest rates. Well, for the last 10 years, or well, not quite 10 years, but for quite a few years, interest rates have been set basically at zero, right? And just over the last year or so, they started kicking these interest rates up. Well, they're trying to kick the interest rates up high enough so they have some ammo during the next recession, right? And that's what they mean by reduced amount of traditional firepower the Fed currently has at its disposal. So yeah, that's what the Fed's trying to do, is they're trying to get some ammo, right? That's why they're raising up interest rates, so they have something to use during the next recession. It goes on to say here, not wholly unrelated to the potential for a trade and tariffs to disrupt policy, a slowdown in U.S. growth could be one thing that catches the Fed's attention, right? Well, that's really important. U.S. growth could be the one thing that catches the Fed's attention. Well, I think it's the thing that's going to catch the Fed's attention, right? I mean, once the U.S. growth stops happening, people are going to feel the pain, and that's where the Fed needs to step in, or supposedly by some of these economists. I'm not saying that. That's what these guys are saying. That's when the Fed's going to step in and try and reduce some of these rates, right? And so that to make the loans easier to flow again. And it goes on to say here, it goes, following an acceleration in economic activity over the past year and a half, there is a deceleration coming, right? So what this economist is saying is that over the last year and a half, we've had a lot of money flowing here, but that's about ready to end, and that's what he means by there's a deceleration coming, right? So it goes on to say here a little bit, and I think probably one of the more important paragraphs comes up here, and it says, another factor that could slow the pace is recognition by the Fed that the neutral rate is not very far away from current policy and does not appear to be moving much higher. If the Fed acknowledges that the neutral rate is 2 hikes away, it would be steps towards turning off autopilot. Okay? Unfortunately, this does not appear to be the case. Instead, much like the yield curve, the Fed seems to believe that the neutral rate will behave differently than it typically does. By projecting more than 2 more rate hikes, the Fed is tactically stating it believes that the neutral rate is going to move higher. Maybe. But it would likely only be moving on a temporary basis, not a sustained one. And that would increase the chances of overshooting the neutral rate, not what the Fed wants to do. So what he's basically saying there is that the Fed is trying to raise these interest rates, but they don't want to exceed the neutral rate, right? And the neutral rate is GDP growth, right? So what the Fed wants to try and do is they want to try and land right at that GDP growth, so neither the Fed is nor accommodative nor restrictive to the economy. It's neutral, right? It's right there in the middle of the two. And that's what he's saying is that at the same time the Fed tries to raise rates, the GDP might drop and it'll overshoot and then forcing the recession to kick in, right? That's basically what he's saying there. I hope that wasn't too complicated. But then I think probably the most important sentence in this entire thing is that a sense of calm surrounding the Fed's current path should be disconcerting. Policy errors happen when confidence is at its highest. So when everybody out there is saying, man, I don't know what you're talking about, everything is booming, housing is booming, everybody has jobs, everything looks great, this guy is saying when that happens, it's time to take concern. That's when the errors of policy happen, is when people are at their highest in competency. And I believe that's where we're at right now. I think we have a super high competency in the economy right now, and I think that's the reason to be concerned. So anyway, that article came out about 6 months ago, right? This article came out just the other day. It came out on the 17th. I believe today is the 18th. And it says, stocks just saw the best earnings season since the financial crisis, and nobody cares, right? And what he goes on to say here, he says, earnings of the S&P 500 companies grew by 25.8% in the third quarter, the strongest performance since the third quarter of 2010. When companies benefited from a very attractive recession-era comparable earnings. So what he is basically saying here is that we have had the best earnings that we have ever reported on the S&P 500 since the Great Recession, right? And as we came out of the Great Recession, we had a nice little boom there, right, where we had an economic growth coming out of the recession. And what he is saying is that we haven't seen that kind of growth until now. So it's been now and way back when we came out of the recession did we see this type of growth, and it was a substantial amount. And what he goes on to say here is that, but the sell-off that accompanied these announcements is a testament to the fact that Wall Street does not care what you have done in the past. It's all about what you're going to do next quarter. So yeah, what they're saying is like, yeah, you might have had a hell of a great earnings season, but what's coming up? I mean, are you going to be earning as much as you did just last quarter, or are things changing on it? And that's where it goes on. That's where it goes on to say this. Even more worrying is the guidance being reported by Apple suppliers, right? So these are the guys who provide Apple with all the parts and pieces to build their products, right? And it goes on to say here, AMS, Lumentum Holdings, and Corvo. Now, I'm not familiar with any of these companies, but apparently these are the suppliers to Apple products, right? These are the people who have the products that Apple uses to build their products with, right? And they all warned of lower than expected sales this week, feeding into the negative sentiment towards America's most valuable company in particular and the tech sector in general, right? So what they're saying is like, hey, this Apple is not going to be doing as well, and we know this because we're not doing as well. We have a bad forward guidance coming up, and it's not looking good for the tech sector in general, right? And then it also goes on to outline this. These stocks were joined by a diverse set of companies from 3M, the guys who make tape and glue and stuff, to Qualcomm. I don't know who those guys are. Anyway, which spooked investors with less than encouraging outlook. So even 3M, who doesn't have anything to do with the tech sector, and these Qualcomm, I don't even know who those people are. I should probably look those up before I did this. But anyway, those guys are saying that we have less than encouraging outlooks for the future, right? So yeah, their earnings might have been good, but these companies see the writing on the wall. They're saying, hey, things do not look good for the future here, And the reason why is this, right? This paragraph here says, macro headwinds, including trade tensions, rising interest rates, and a strong dollar, and slowing growth abroad, have also helped to trigger a pivot towards negative sentiment in the market, right? So they're saying, yeah, America might be doing good, right? All the stocks in America are kicking ass and everybody's real happy about it. But the trade tensions, rising interest rates, and a strong dollar, right? Plus the slowing growth abroad. So all these other countries are saying, hey man, we're feeling weakness going on here. That's going to be an issue for America, and he says so right there with the slowing growth abroad. Everybody knows that a strong dollar is going to be bad for stocks and stuff like that, because basically what a strong dollar is money being sucked out of the system, right? When you have like easy credit, you got a lot of money flowing into the system. And this is where like the reasons why the stock market went up and the housing market went up and the bond market went up is because all this money that got generated, that got printed and loaned into the system, that's where it all went to. It went to the stock market, it went to bonds, it went to real estate, right? And as the Fed raises interest rates and starts pulling some of this credit back out of the system, well, there's less dollars to float around. So unfortunately, that means asset prices have to come down in order to compete for the amount of dollars that are out there in the system. Does that make sense? That's why the strong dollar is going to be bad for stocks. But I think probably what's the most important part down here is it goes on to say, while the U.S. markets, or I'm sorry, the market knows that earnings growth has peaked. And so earnings growth can't be the reason any longer to ignore the macro picture. So what he is saying is like, yeah, while these stock markets were running up and everybody was doing really good as far as their portfolios go, that was because these earnings were going to be so good. Now that earnings is over, what do you got? What do you got out there? Well, we already know that there's trade tensions, rising interest rates, strong dollar, and slowing growth that are probably going to be headwinds for the markets. And since earnings growth is over, now what? So this is where the future, now we got to step in here and find out what's going to happen as far as the markets go. And then I'm going to end this, the last part of this article with this part. It says, while U.S. markets will be closed Thursday for Thanksgiving Day holiday, there will be much data for investors to digest in the week ahead, starting with the National Association of Home Builders Index on Monday at 8:30 a.m. Later that day, the Federal Open Market Committee member of the New York Fed President, John Williams, will participate in a moderated question and answer session in New York, right? So here we're going to have some National Association of Home Builders come out here and say, hey, we're going to tell you how the housing market's doing. And we're going to do that Monday a.m., right? So my prediction of what's going to be said inside of that announcement from the home builders, right? Because now I'm in the industry, right? I work in the building supply industry. And so I see a lot of what's going on here in the housing markets. And one of the things that I noticed right off the bat, let me get my notes together here if I can. Okay, so looks like I'm missing one of them here. Bummer. Well, regardless, I think we could probably still kind of go on with this and show you anyway. So what I'm going to show you first here is, are you guys familiar with the stock ticker DHI? It's D.R. Horton. They're a home builder, right? And they're like the biggest home builder in the entire nation. And they build like high-end homes, low-end homes. They build senior citizen, homes for senior citizens and stuff like that. And I'm going to show you their stock chart. Now, I had another one here that I wish I could have showed you, but it looks like I am missing it right now, which is kind of a bummer because it was a really good chart to show you. But basically, this is it right here. And let me see if I can get it up to you. So I drew a black trend line there. You see it? And you can see how it bounced off that trend line all the way up till now. And it's just about ready to touch that trend line. Okay? But what's more importantly is look at the growth that it had over 2017. That is incredible growth right there. And then it just fell off a cliff, essentially. Okay? So if home building was going hot and heavy and was booming, this year wouldn't look like that, okay? This is beyond just a pullback. Those are pullbacks that come down and touch the line. This was an exponential growth, and that is essentially a crashing, okay? And this is a 5-year chart right here. So you can see the last year from these guys have not been doing very well. And I think probably what is even more telling is this supplier here, right? These guys, it's Fortune Brands Home and Security, and what these guys do is they build like entry doors, they do cabinets, they do locks, like they do all the parts and pieces that would essentially go into a house, right? And this is really telling right here. Take a look at this. This is their year-long chart, and look at that channel that they're in, right? Totally going downhill. And then what's even more telling is see that little bit right there, that little tiny mark. They busted the trend line. They busted that downward trend line. Now, they did pop right back up above it again, and now they're still following that trend line down. But what's even crazier is if you go and you look at the 5-year chart on that one, right? Because if you go back 5 years, look at this. Look at what happened over the last year, okay? they had this huge growth and then bam, off the cliff. And not only did they go off the cliff, they busted that downward trend line, or that growing trend line, and they couldn't beat it, right? They busted the trend line and they come up and they touched it again. They couldn't break that trend line and down they went, right? So this is really telling, guys, you know, if a housing market was booming, if it was rocking and rolling, if I was like completely nuts on what I was saying, those charts wouldn't look like that. Those charts would be continuing upward and heading off into the stratosphere, but they're not. They're pulling back, and the reason is that we're having a slowdown in the housing market. We're having a slowdown in general, and these are the early warning signs. Okay, guys? So I'm going to step back, let you guys get a nice shot of the beach, of the ocean. Oh, one more thing. One more before I let you guys go, right? Building supplies, right? So you guys know that I follow half-inch CDX. I think that's like one of my #1 indicators of where we are in the housing market. And I wanted to go back and take a look. We peaked out with CDX prices there at the yard at $25.50. Today they are selling at $19.49. A year ago, we were selling it at $24.21 a sheet. Okay, so that's very telling, guys. We are dropping dramatically in the CDX price. And what's even more dramatic is the OSB. Now, I don't like following OSB as much because that one can be really dramatic. If there's a hurricane, OSB flies off the charts, right? But the numbers don't lie, right? We peaked out. We sold OSB at the height this year, or of this last season, at $19.88 a sheet. Today, we sell it at $12.39 a sheet. That is a huge drop, guys. That's like pushing 80%, right? And a year ago, we were selling that 7/16 OSB at $17.79. So a year ago at $17.79, today we're selling at $12.39. It peaked out at $19.88. Guys, that is a huge drop. Now, if we were having a booming housing market, if we were having like a lot of material flying out there for people to put together, OSB would not be selling as low as $12.39 right now, okay? And half-inch CDX wouldn't be at $19.49. This is telling, guys. It is very, very telling. And I think come Monday morning, it's going to tell us a whole lot more about the housing industry, and I think people are going to start agreeing with me a little bit more. All right? Uneducated economists, you guys are beautiful. Thank you very much. I really appreciate everything as far as the subscriptions and the great comments. I love you very much. Okay, now here's the shot of the beach. All right, love you guys.